Imagine two women. Both are 62, both just retired, both have exactly $2 million. Both own same index funds, both plan to withdraw $80,000 a year, adjusted for inflation. Both will experience an average annual return of 7% over the next 30 years. One of them dies at 92 with more money than she started with. The other one runs out of money at 82 and spends the last 10 years of her life cutting back, moving in with her adult children, and wondering where she went wrong. The difference between them is not their portfolio, not their discipline, not their spending, not their asset allocation. The difference is the year they retired. One retired in a year where the market went up for the first 5 years. The other retired in a year where the market went down for the first 3. Same average return over 30 years, same spending, same portfolio. Catastrophically different outcome. That sequence of returns risk. And for you, the women who's 5 to 15 years from the retirement date you want, it is the single biggest structural threat to that date actually happening. I'm Hazel Secco, CFP and CDFA, founder of Align Financial Solutions. Here's the cleanest way to see sequence risk. Think about your 401k during your working years. You contribute every month. The market goes up and down. At the end of 30 years, if your average annual return is, let's say, 8%, you land roughly where you'd expect to land. And in real accumulation, when you're contributing to your 401k every check, the order of returns matters far less than it does in retirement. Why? Because you're a net buyer. Bad early years actually work in your favor. You're buying more shares cheap. Now, switch the direction. In retirement, you're not adding, you're subtracting. You're selling shares every year to fund your lifestyle. The moment you become a net seller, the math flips. Imagine you retire with $2 million. In year 1, the market drops 30%. Your portfolio is now $1.4 million. You still need your $80,000 that year. So you sell shares at a temporary low. You're locking in the loss and removing the capital that can't recover. Compare that to the woman whose first year was a 30% up year. Her portfolio went to $2.6 million. She pulled her $80,000 from a much larger pool. She never sold shares at a low. If the bad years happen early in years 1, 2, 3, 4, 5 of retirement, you can run out of money even if your average long-term return is perfectly healthy. If the bad years happen late, you've already banked a decade of withdrawals from growing balances and you probably finished with more than you started. The first 5 years carry more weight than the next 25, not by a little, by a lot. At Align, we call this the retirement runway. The 5-year window on either side of your retirement date. Wade Faw and Michael Kitces have studied for roughly a decade. If a major market correction happens inside your runway, the damage can be permanent. The version of this that actually happened, women who retired in 2000 at the top of the dot-com bubble, by 2003, their portfolios were down 40 to 50%. They needed their withdrawals every year. By the time the market fully recovered in 2007, they'd already locked in 8 years of selling into a decline. And then 2008 hit. A lot of women who retired in 2000 with $1.5 to $2 million did not make it to 2030 without running out. Sequence risk is not theoretical. It's the specific mechanism by which retirement failed. A woman with 1.5 million or more has a different set of tools, the bucket strategy. You divide your portfolio into 3 buckets based on time, not necessarily risk tolerance. Bucket 1, 1 to 2 years of living expenses in cash, money market, short T-bills. This is what you actually draw from. Bucket 2, 3 to 7 years of living expenses in high quality bonds, bond funds, or a bond ladder. This refills bucket 1. Bucket 3, everything else. Your equity growth portfolio. This is the long-term engine. You don't touch it during a downturn. The logic, when the market drops, you don't sell stocks. You live off of bucket 1, bucket 2 refills bucket 1, and you give bucket 3 time to recover. You only touch bucket 3 after the market has recovered. For a woman with $2 million, bucket one might be $150,000 to $200,000 in cash. Bucket two might be $400,000 to $600,000 in bonds. Bucket three is the remaining $1.2 to $1.4 million in equities. This isn't aggressive. It isn't sophisticated. It's the boring structural protection across the retirement runway that works. The shape is a tent. Bond allocation peaks at retirement and tapers down on both sides. For women who've been in target date funds, those funds are built on the traditional age in bonds glide path. They do not protect you from sequence risk. You might need to build the bond tent manually. You've probably heard of the 4% rule. Withdraw 4% of your starting portfolio in year one, adjust that amount for inflation every year after. It was back-tested finding, not a prescription. The rule was designed to survive the worst historical sequence. It assumes you retire into the worst possible starting conditions. More importantly, the 4% rule is static. You pick a number in year one and inflation adjusts it forever, regardless of what the market does. That's not how real humans behave, and it's not what the research recommends anymore. This is a specific dynamic rule set developed by Jonathan Guyton and William Klinger in a 2006 Journal of Financial Planning paper. You set an initial withdrawal rate, say 5% of starting portfolio. You set an upper guardrail, say 6%, and a lower guardrail, like 4%. If the market goes up enough that your current withdrawal rate drops below 4% of your current portfolio, you get a raise. If the market goes down enough that your current withdrawal rate exceeds 6% of your current portfolio, you cut your withdrawal until you're back inside the guardrails. The guardrails are mechanical. They take emotion out. The result is that a portfolio that's much less likely to fail and an income that's more likely to grow over time compared to the static 4% rule. For most women in my client base, the playbook looks like this. Build a cash reserve or bucket structure in the 2 years before retirement, and build a bond tent around the retirement date. Use a dynamic or guardrails-based withdrawal rule, not a static 4%. Revisit the whole system with your advisor at least annually. Here's the part that matters most and that no spreadsheet captures. The preparation has to happen before you need it. You can't build a cash reserve in the year the market drops. You can't build the bond tent after the correction is already underway. By the time you need the protection, it's too late to install it. The women who clear the retirement runway cleanly are not the ones who make brilliant decisions during the downturn. They're the ones who made boring decisions 3 years before the downturn. They set up the structure, they funded the buckets, and then when the market dropped, they didn't have to sell. The discipline is in the preparation, not the reaction. Building a cash reserve in year when the market is up and equities feel great means accepting a return drag. Watching your stock-heavy friends post higher 12-month returns and wondering if you're leaving money on the table. You are deliberately. You're paying for the ability to not sell in the year. It could cost you everything. If you want me to look at your specific allocation and tell you whether you have the structural protection in place for sequence risk, the Align call is 15 minutes. Link is right next to the assessment. You'll leave knowing whether your portfolio is runway ready. See you there.